How do you invest in a volatile market? The first thing you need to do is understand what volatility actually is. Volatility, as it pertains to the stock market, is the rapid and unpredictable change in a stock's price. Most people tend to associate higher volatility with a negative trending market, and quite often this is true. Probably because stock prices tend to go down much faster than they go up. But the reality is, volatility matters more about the unpredictable change in a price than it does the direction of the price. And the number one thing to remember is that volatility equals opportunity. Yes, a volatile market holds more risk, but it also increases the potential returns in a shorter period of time. Higher returns always comes with more risk. For the average long-term buy and hold investor, one way to mitigate the risk is simply by dollar cost averaging. Dollar cost averaging is the act of investing a fixed dollar amount on a regular basis into a particular investment. If the market goes down, you will purchase more shares, and if the market goes up, you'll purchase less shares. But you're doing so at no extra cost than you were before, and you're focusing on the overall long term upward trend of your particular investment. However, if you're looking for a more lucrative short term opportunity, then I would suggest trading options. To be more specific, selling options, and to be even more specific, selling put options. Option contracts tend to be valued much higher in a volatile market, and put option premiums are extra juicy because investors are buying them to hedge their current market gains against potential negative price movements. Selling put options may come with a capped return. However, it gives you the ability to determine your own risk and probability of success. Investors who buy options have to not only guess right on the direction of a stock's price, but have to fight time decay and a change in volatility as well. If volatility is spiking, chances are volatility is going to fall, which reduces the value of the contract that you're selling. As the contract nears expiration, the chances of the strike price being met becomes more and more unlikely, and this means the contract becomes more and more worthless. If the option expires without meeting the strike price, or formerly known as out of the money, then you keep the entire amount that you sold it for. On the flip side, if you sell a put option and the stock price is at or below the strike price, you still get to keep the premium, but you now have to purchase 100 shares of that stock at the strike price. However, if you wanted to own the shares of the stock anyway, then selling the put option is nothing more than a buy limit order of a company that you want to own anyways, that is partially subsidized by the current shareholder. Think of selling put options as a way to collect income on a stock that you want to own in the future, but at a substantial discount to what it's trading at today. And the more volatile the stock, the more income you can bring in while you wait to get in at the price that you want to buy it at.